Hello, Singapore. Welcome back to another episode of the Investing Iguana. I'm your host, Iggy, and today we've got a topic that's as intriguing as it is risky, the world of short selling. If you've ever watched the movie The Big Short and wondered if you could do something similar right here in the Lion City, then this episode is for you. Before we dive in, if you're new to this channel, don't forget to hit that subscribe button and ring the notification bell so you never miss out on the latest investment insights. Let's dive deeper into the topic of The Big Short, a movie that takes a closer look at the events that led to the 2008 financial crisis, specifically focusing on the collapse of the housing market. In this film, we follow the journey of a handful of savvy investors, with Michael Burry at the helm, who were able to predict the upcoming disaster. They decided to go against the grain and bet against the housing market, and as a result, they ended up making a fortune, hundreds of millions of dollars, to be exact. The story is incredibly captivating, and it naturally makes us curious. It leads us to ask questions like, is it possible for regular folks, like you and me living in Singapore, to do something similar? Could we potentially place a bet against something like the Straits Times Index, which is a stock market index in Singapore, or even against the local property market, and walk away with a profit? Well, that's an interesting question and definitely worth exploring further. So, let's take some time to investigate whether ordinary Singaporeans could also take advantage of market trends to make some money. What is short selling? In the world of money and investing, there's something called buying long, which is like buying a toy and hoping its value goes up so you can sell it for more money later. It's like saying, I think this toy is going to be really popular, so I'll buy it now and sell it for more money later. But what if you think the opposite? What if you think that the toy isn't going to be popular and its price will go down? That's where short selling comes into play. Imagine you borrow a toy from a friend, sell it, and plan to buy it back later when it's cheaper. You're basically making a bet that the toy's price will drop. If you're right and the price goes down, you buy the toy back for less money, return it to your friend, and keep the difference as your profit. Yay, you win. But if you're wrong and the toy becomes super popular and expensive, you'll have to buy it back at a higher price, return it to your friend, and you end up losing money. And sometimes, you can lose a lot of money if you're really wrong. So, short selling is like a game of guessing whether something will lose value, and it can be a way to make money, but it's also risky and you have to be careful. If it does, you make money. If it doesn't, well, you lose, and the losses can be substantial. So, you're curious about how short selling works, huh? Well, in the usual way of doing things, like in stock markets, what you do is borrow something like a stock or asset from someone who already owns it. You then sell that borrowed item right away. After some time, when the price of that item has gone down, you buy it back. You then return this newly bought item to the person you borrowed it from in the first place. The cool part? You get to keep the difference between the selling price and the buying price as your profit. But, wait, it's not always that simple. Sometimes, you might not find a person who's willing to lend you what you want to sell. Also, there are rules and laws about this. In some places, like Singapore, there are even specific conditions where you're not allowed to do short selling at all. So, what can you do instead? Well, there's something called financial derivatives. These are special things like contracts for difference, CFDs, or spread betting that let you make a bet on whether the price of something will go up or down. The awesome part is you don't even have to own the thing you're betting on. In Singapore, you can use special websites like Iggy Markets or City Index to do this kind of betting on prices. So, you see, there are different ways to play the game, but each comes with its own set of rules and challenges. Okay, let's slow down and take a deep breath for a moment. Short selling, which is a way to make money when you think a stock's price is going to go down, isn't a good fit for everyone. You see, when you buy a stock hoping it will go up, the most you can lose is the money you put in to buy it. But with short selling, it's a whole different ball game. If things don't go your way and the stock price actually goes up instead of down, you could lose a lot more money than you initially invested. In fact, there's no limit to how much money you could lose. It's like playing a game where the points can keep going against you forever if you're not careful. That's why it's super important to have safety nets in place, like something called a stop loss. A stop loss is like a financial seatbelt. It automatically stops your investment and pulls your money out if you start losing too much. It's a way to say, okay, that's enough loss for me, and it helps you avoid losing more money than you're comfortable with. So, if you're thinking about short selling, make sure you understand the risks and have safety measures like a stop loss in place. So, you're wondering if you can be like Michael Burry, the famous investor, but in Singapore? Well, the situation is a bit more complex here compared to the United States. You see, in the US, you have the freedom to bet against, or short, a wide variety of markets directly. But in Singapore, your choices for doing that are not as extensive. However, don't worry, you still have some options. Let's say you're really interested in the property market and you have a hunch that it's going to go down. What you can do is look at companies that build properties and are listed on the Singapore Stock Exchange, also known as SGX. You can bet against their shares, essentially saying you think their value will drop. But that's not all. You can also use special financial tools called derivatives to make educated guesses against market indicators like the Straits Times Index. Oh, and if you're into things like gold, oil, or foreign currencies, you can also short those markets. The most important thing to remember, though, is that being successful at shorting isn't just about making a quick decision. You need to do your homework, pick the right moment to jump in, and always be careful about the risks you're taking. So, while it's a bit more challenging in Singapore, you can still try your hand at shorting if you're smart and careful about it. Alright, let's dive into some really important advice for becoming a great short seller, which means you're someone who makes money when a stock's price goes down. First up, you've got to really believe in your own ideas, even if most people don't agree with you. Imagine you're the only one in your friend group who thinks a certain movie is going to be a flop. If everyone else already thought the same, then there wouldn't be a chance to show you were right and maybe win a bet on it. It's the same with short selling. If everyone agrees with you, the stock price would already be low, and you wouldn't make any money. Next, let's talk about not putting all your money into just one stock. This is called diversification, and it's super important. Think of it like you're playing a game of poker. In poker, you don't bet all your chips on just one hand, right? You spread out your bets to have a better chance of winning in the long run. Well, experienced short sellers do the same thing. They don't just bet against one company, they bet against several. This way, if one bet doesn't work out, the others might still make them money. So, just like in poker, you're playing the odds and being smart about where you place your bets. By doing these two things, believing strongly in your own ideas and spreading your bets, you'll have a better shot at being a successful short seller. Third, it's super important to keep a close eye on what's happening all the time. Imagine the market as a really fast video game where things can change super quickly. We're talking about changes that can happen in a split second, especially because we're living in a world where everyone is online and information travels at the speed of light. You've got to be like a detective, always looking out for clues in the form of news updates, what's trending on social media, and all sorts of numbers and charts that can give you hints about what might happen next. Fourth, remember that good things come to those who wait. Think of the market like a big, complicated puzzle. Sometimes, it takes a while for all the pieces to fit together the way you think they should. Just because things aren't going super fast doesn't mean you should give up or make hasty decisions. It's like fishing. You can't just throw your line in the water and expect to catch a fish immediately. Sometimes you have to wait patiently for the right moment. Fifth, always know how you're going to get out before you even get in. It's like playing a game of tag. You need to know where the safe zones are so you can run to them when you need to. In the world of markets, this means you should have a plan for when things don't go your way, like knowing when to stop and take a step back so you don't lose too much. But also, know when it's the right time to celebrate and take your winnings. Tools like stop-loss orders are like your game plan. They help you decide when it's time to make a move, either to protect yourself or to grab your rewards. Alright, everyone, that brings us to the end of today's exciting episode where we delve deep into the fascinating but also potentially dangerous realm of short selling in the stock market. I truly hope that this episode serves as a helpful guide for you, especially if you're thinking about venturing into this specific type of investment strategy. It's crucial to understand that while the financial gains can be really impressive, the level of risk you're taking on is just as substantial. So, before you jump in, make sure you've done all your homework, research the market, understand the trends, and most importantly, seek advice from qualified financial experts to ensure you're making well-informed decisions. If you found today's episode to be enlightening and useful, I'd really appreciate it if you could hit that thumbs up button and also share this episode with your friends, family, or anyone else who might benefit from it. If you haven't joined our community yet, what are you waiting for? Go ahead and smash that subscribe button, and don't forget to ring the notification bell. That way, you'll never miss out on any of our future episodes packed with valuable investment advice and strategies. So, until we meet again in the next episode, this is Iggy from the Investing Iguana, saying goodbye for now. Keep on investing, Singapore, and let's all strive to make smarter financial choices.